warned, the echoes of history are sounding an ominous tone on Wall Street. Financial journalist Andrew Ross Sorkin, an expert on the infamous 1929 stock market crash, has issued a stark warning. He sees worrying parallels between today's market and the pre-crash environment of the Roaring '20s. A boom or a bubble? The recent surge in AI and technology has driven an incredible economic boom. But Sorkin cautions that this boom may be a sugar rush, a short-lived high that could soon come crashing down. He believes a market crash is inevitable, but the timing and depth remain uncertain. The Roaring '20s redux. Despite a recent tumble, Wall Street stocks have been on a tear. Some investors are feeling nervous, sensing an overheated market.
Sorkin, author of 1929 Inside the Greatest Crash in Wall Street History, draws a parallel to the 1920s, when stocks reached record highs before the Great Depression. He expresses anxiety about today's market highs, unsure if they're sustainable or artificially inflated by AI and technology. The speculative bubble of 1929. The market in 1929 was driven by rampant speculation, with ordinary investors borrowing heavily to invest, often unaware of the risks. Wall Street bankers enticed people of modest means to invest using credit, a concept then known as buying on a margin. Investors only needed to put down 10% of the stock price, borrowing the rest from their bankers. Before 1919, most people avoided credit and debt due to religious and moral norms. But General Motors changed that by lending money to customers to buy their cars.
This innovation transformed American shopping habits, and soon, bankers realized they could lend money to investors, wrapped in the flag of democratizing access to the stock market. The AI boom and economic uncertainty today, hundreds of billions are being invested in AI, with some experts warning of a possible bubble. Stocks are soaring to unprecedented heights, even as economic uncertainty looms, as seen in the slide after President Trump's threat of more China tariffs. Sorkin believes we're in a bubble of some sort, the question being when it will burst. Protecting investors, guardrails, and regulation. In the aftermath of the 1929 crash, laws, regulations, and agencies were established to protect investors. However, Sorkin notes that some of these protective barriers are being dismantled. U.S. Securities and Exchange Commission rules have become less stringent, and the Consumer Protection Bureau is virtually non-existent. That's what concerns me, Sorkin said. It's not about falling off a cliff tomorrow, but about speculation and increasing debt in the market, all against the backdrop of regulatory guardrails being removed. These guardrails include restrictions on direct investment in private companies, such as AI startups, which have fewer regulations compared to public companies. The push for democratizing investing. In his annual letter to investors, BlackRock CEO Larry Fink proposed opening retirement 401ks to riskier private investments, arguing for the democratization of investing. He sees opportunities in AI and data centers, but acknowledges the risks involved. Fink, who once dismissed Bitcoin as the domain of money launderers and thieves, now wants to add crypto to investment portfolios. He believes the markets teach us to reevaluate our assumptions and that crypto, like gold, can offer an alternative investment. The dark side of democratization. Sorkin warns that some crypto products, like meme coins, can be abused in ways reminiscent of 1929. With speculators driving up the value of cryptocurrencies before they crash. He shares a personal example involving a TV appearance with Fink where a Sorkin coin was created, reaching millions in value before crashing. I think today it does something like $20 or $21 a day, Sorkin said. Final thoughts. As we navigate the complex world of finance, the lessons of history serve as a cautionary tale. The push for democratizing investing must be balanced with the protection of investors. The question remains, are we on the cusp of another market crash? And if so, are we prepared for the consequences? What are your thoughts on the matter? Do you see the parallels between today's market and 1929? Share your insights and join the discussion in the comments below.